In this lecture, we're going to be talking about market efficiency. Now, you've probably heard that saying before, or that word before: the market is efficient, it's extremely efficient, or it's not efficient. Now, what does market efficiency mean? And just off the regular definition here from the slide, market efficiency is the degree to which a stock prices reflect all available relevant information. So when somebody says the market is efficient, what they're saying is that the price includes the publicly available information available. So if you come and tell me, you know what, I think Apple stock is going to go up because there's the new iPhone 10 that came out. Well, I might tell you, well, the fact that the iPhone 10 came out, you're not the only one who knows about that. Everybody else knows that there's the iPhone 10, and everybody has already used that information to buy or sell, so that information is already included in the current price. So I don't need to look at that, okay? Because that information is already included. That would mean that the market is efficient, where it effectively takes all the information and prices that into that financial product. So obviously not all products are as efficient as each other, and not all other products within a product are efficient. So let's say within the stock market there might be stocks that are more efficient than others. Now, that being said, the efficient market hypothesis, which we call EMH, is a theory that states that it's impossible to beat the stock market because the stock market efficiency causes existing share prices to always incorporate and reflect all relevant information. So basically, you can't beat the stock market, because how could you beat it if all the information that you could use to beat it is already included in the price, which leaves it to move in a random manner, right? Because it's only new information that's going to move it, and you don't have access to that information. Now, the EMH hypothesis has three different forms. It has weak efficiency form, semi-strong efficiency form, and strong efficiency form. So first of all, let's look at weak efficiency. Weak efficiency states that all historical prices are already included in today's price, and thus it is useless to look at historical prices to try and predict the future. So if I take, let's go to TradingView. If I go on TradingView and I pull up any stock, right? So let's say I'm going to pull up, and since we've been talking about Apple, let's put up Apple, AAPL. If I go on Apple and I just open its chart right here, if I take a look at Apple, and then here we go, here's Apple. Let's put a daily chart. Okay, so if I'm looking at Apple right now, and I look at this chart and I say, well, you know what? It looks like prices are going up and there's an uptrend or whatnot. Can I use that information to predict the future stock price? Can I say that because there's an uptrend, it should continue going up? The weak efficiency form says that no, because this information, all these prices, everybody sees them, and everybody already used them to buy or sell, and that's why the price is what it is. So it's already included in the price. So we should not be able to use that information. Now, sorry, I got this. This is the recording. So now the other level or other hypothesis is the semi-strong efficiency. And semi-strong efficiency says that not only you cannot use historical prices, but you cannot use financial data, fundamentals, right? So you can, not only can you not use the prices, but you can't use fundamentals like earnings, dividends, the sector, the economy, the taxes, geopolitical environment. You can't use any of that because everybody already knows all these fundamentals, and everybody has already used them to price the stock and to buy or sell the stock. Thus, that information is already included in the price, and you analyzing it is not going to give you an edge. Okay, so when you're looking at semi-strong, it says you can't use technicals nor fundamentals. Now, if you go a step further, there's actually the strong efficiency form, which this is the strongest form out of all of them. And this form says that you can't use technicals, you can't use fundamentals, and you can't even use private information that's not public. So even if you're able to get some information that nobody knows about, other than the CEO and higher management, you're not going to be able to make money. Why? Because probably the CEO and the higher management told their family and friends, and they told their family and friends, and enough people know and use that information to buy or sell, that the price of the stock has already moved to account for that information. So these are the three types of efficiency forms. Now, every single person, or not every single person, but usually people are gonna, subscribe to one of these forms. Some people believe that, the market is, let me just open this up. Some people are gonna believe, come on, let me just get this on. Give me a second, gotta plug my pen in. Okay. So, let's put this back here. Some people believe that the market is very weak efficient, right? So, or weak efficient, that's how they call it. Weak efficient. And weak means that you cannot use technicals. Some people believe it's semi-strong, right? And that means you can't use technicals, plus you can't use fundamentals. You could use private information. And then you have strong efficiency form, which this one says you can't use technicals, you can't use fundamentals, you can't even use private information. So there's literally absolutely no way to make money. Now, do we believe in this one? No, obviously not. If you have private information that the public doesn't know about and you use that information, you are going to make money. And that's why it's illegal to do that, and you'd go to jail if you do that. So obviously, no. Now, do we believe in semi-strong? I had a teacher who believed in semi-strong. My first teacher who taught me this material told me, yeah, it's semi-strong. The reason why he told me that, and a lot of people, their belief is based on their experience. A lot of people who believe in that are people who actually traded the stock market but were unsuccessful. So if you go and you try to beat the stock market and you're unable to beat it, what are you going to say? You're going to say, yeah, well, you know what? The market is already efficient. So all this information that I used to try and predict the market was already incorporated, and, the market is random. You can't beat it. That's what they're going to say. So, but somebody else who consistently beats the stock market is going to tell you, no, the stock market is very weak. So depending on who you're talking to, if they're successful or not in the business, they might have a different view. I obviously do not believe that it's semi-strong at all, because obviously you could use fundamental and analyze it in a different way and make consistent money. Now, what about weak efficiency? Weak efficiency says you can't use technicals. Well, you know what? I believe that the market is not weak efficient, because we do use technicals sometimes and make money just by using technicals and nothing else, right? And a lot of people do that. So obviously, the market is not weak efficient. So there's actually, I think, there should be another one that says it's very, very weak. Because to be honest, and again, one of my new traders that started here a few months ago, after a month, he came to me and he's like, I can't believe how inefficient the market is. We see a news, the stock moves a few days after the same news comes out, nothing new, everything is the same. Stock does the same move again, goes up the same amount of percentage. So there's a lot of inefficiencies in the market that you can make money not only by using fundamentals, but technicals and sometimes just price action by itself. So this is really me telling you that the market, or the stock market specifically, is extremely inefficient. When you're looking at, let's say, the foreign exchange market, well, the foreign exchange market is very big. So it's very efficient. If the FX rate between Canada and USD is 1.25, well, it's 120 2025 because everybody agreed on that. Everybody who bought and sold agreed on that price at this moment. So that's what it's worth, right? Now, if you're looking at stocks, well, the stocks aren't as big as the FX market, right? Because in stocks, you have the FX market in one day trades more money than the whole US stock market is worth, all of it together, right? So the amount of money that goes in the foreign exchange market is huge compared to the stock market. Now, within the stock market, you have some companies who are extremely small, who trade 50,000 shares a day, not a lot. And do you think that these companies are actually efficient and they reflect all information? No, because all it takes is one big buyer or one big seller to buy or sell some, and the price might move in a certain direction just because of supply and demand, and not necessarily because of actual reasons. So there are a lot of mispricings in the stock market, so inefficiencies that we as traders want to capitalize on and take advantage of these mispricings and take advantages of the corrections that happens following these mispricings. Okay, so that's just a little bit of talk about market efficiency, and that should be it. So guys, I'm gonna see you in the next lecture.